Section 9 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 3, Securitization and Derivatives, Part 2, Structured Finance. While Fannie and Freddie enjoyed a near monopoly on securitizing fixed-rate mortgages that were within their permitted loan limits, in the 1980s, the markets began to securitize many other types of loans, including adjustable-rate mortgages, or ARMs, and other mortgages the GSEs were not eligible or willing to buy. The mechanism worked the same. An investment bank, such as Lehman Brothers or Morgan Stanley, for a securities affiliate of a bank, bundled loans from a bank or other lender into securities and sold them to investors, who received investment returns funded by the principal and interest payments from the loans. Investors held or traded these securities, which were often more complicated than the GSE's basic mortgage-backed securities. The assets were not just mortgages, but equipment leases, credit card debt, auto loans, and manufactured housing loans. Over time, banks and securities firms used securitization to mimic banking activities outside the regulatory framework for banks. For example, where banks traditionally took money from deposits to make loans and held them until maturity, banks now used money from the capital markets, often from money market mutual funds, to make loans, packaging them into securities to sell to investors. For commercial banks, the benefits were large. By moving loans off their books, the banks reduced the amount of capital they were required to hold as protection against losses, thereby improving their earnings. Securitization also let banks rely less on deposits for funding, because selling securities generated cash that could be used to make loans. Banks could also keep parts of the securities on their books as collateral for borrowing, and fees from securitization became an important source of revenues. Lawrence Lindsay, a former Federal Reserve governor and the director of the National Economic Council under President George W. Bush, told the FCIC that previous housing downturns made regulators worry about banks holding whole loans on their books. Quote, if you had a regional real estate downturn, it took down the banks in that region along with it, which exacerbated the downturn, unquote, Lindsay said. Quote, so we said to ourselves, how on earth do we get around this problem? And the answer was, let's have a national securities market so we don't have regional concentration. It was intentional, unquote. Private securitizations, or structured finance securities, had two benefits to investors: pooling and tranching. If many loans were pooled into one security, a few defaults would have minimal impact. Structured finance securities could also be sliced up and sold in portions, known as tranches, which let buyers customize their payments. Risk-averse investors would buy tranches that paid off first in the event of defaults, but had lower yields. Return-oriented investors bought riskier tranches with higher yields. Banks often compared it to a waterfall. The holders of the senior tranches at the top of the waterfall were paid before the more junior tranches. And if payments came in below expectations, those at the bottom would be the first to be left high and dry. Securitization was designed to benefit lenders, investment bankers, and investors. Lenders earned fees for originating and selling loans. Investment banks earned fees for issuing mortgage-backed securities. These securities fetched a higher price than if the underlying loans were sold individually, because the securities were customized to investors' needs, were more diversified, and could be easily traded. Purchasers of the safer tranches got a higher rate of return than ultra-safe Treasury notes without much extra risk, at least in theory. However, the financial engineering behind these investments made them harder to understand and to price than individual loans. To determine likely returns, investors had to calculate the statistical probabilities that certain kinds of mortgages might default, and to estimate the revenues that would be lost because of those defaults. Then investors had to determine the effect of the losses on the payments to different tranches. This complexity transformed the three leading credit rating agencies, Moody's, Standard & Poor's or S&P, and Fitch, into key players in the process, positioned between the issuers and the investors of securities. Before securitization became common, the credit rating agencies had mainly helped investors evaluate the safety of municipal and corporate bonds and commercial paper. Although evaluating probabilities was their stock in trade, they found that rating these securities required a new type of analysis. Participants in the securitization industry realized that they needed to secure favorable credit ratings in order to sell structured products to investors. Investment banks therefore paid handsome fees to the rating agencies to obtain the desired ratings. Quote, "The rating agencies were important tools to do that, because the people that we were selling these bonds to had never really had any history in the mortgage business. They were looking for an independent party to develop an opinion," unquote. Jim Callahan told the FCIC. Callahan is the CEO of Pent Alpha, which services the securitization industry, and years ago he worked on some of the earliest securitizations. With these pieces in place, banks that wanted to shed assets and transfer risk, investors ready to put their money to work, securities firms poised to earn fees, rating agencies ready to expand, and information technology capable of handling the job, the securitization market exploded. By 1999, when the market was 16 years old, about $900 billion worth of securitizations, beyond those done by Fannie, Freddie, and Ginnie, were outstanding. See Figure 3.1 in the printed version of the report. That included $114 billion of automobile loans and over $250 billion of credit card debt. Nearly $150 billion worth of securities were mortgages ineligible for securitization by Fannie and Freddie. Many were subprime. Securitization was not just a boon for commercial banks, it was also a lucrative new line of business for the Wall Street investment banks, with which the commercial banks worked to create the new securities. Wall Street firms such as Salomon Brothers and Morgan Stanley became major players in these complex markets and relied increasingly on quantitative analysts called quants. As early as the 1970s, Wall Street executives had hired quants, analysts adept in advanced mathematical theory and computers, to develop models to predict how markets or securities might change. Securitization increased the importance of this expertise. Scott Patterson, author of The Quants, told the FCIC that using models dramatically changed finance. Quote, "Wall Street is essentially floating on a sea of mathematics and computer power," unquote, Patterson said. The increasing dependence on mathematics let the quants create more complex products and let their managers say, and maybe even believe, that they could better manage those products' risk. J.P. Morgan developed the first value at risk model, or VAR, and the industry soon adopted different versions. These models purported to predict with at least 95% certainty how much a firm could lose if market prices changed. but the models relied on assumptions based on limited historical data. For mortgage-backed securities, the models would turn out to be woefully inadequate, and modeling human behavior was different from the problems the quants had addressed in graduate school. It's not like trying to shoot a rocket to the moon where you know the law of gravity. Emmanuel Derman, a Columbia University finance professor who worked at Goldman Sachs for 17 years, told the commission, "The way people feel about gravity on a given day isn't going to affect the way the rocket behaves." Paul Volcker, Fed chairman from 1979 to 1987, told the commission that regulators were concerned, as early as the late 1980s, that once banks began selling instead of holding the loans they were making, they would care less about loan quality. Yet, as these instruments became increasingly complex, regulators increasingly relied on the banks to police their own risks. Quote, "It was all tied up in the hubris of financial engineers, but the greater hubris let markets take care of themselves," Volcker said. Vincent Reinhart, a former director of the Fed's Division of Monetary Affairs, told the commission that he and other regulators failed to appreciate the complexity of the new financial instruments and the difficulties that complexity posed in assessing risk. Securitization, quote, "was diversifying the risk," unquote, said Lindsay, the former Fed governor. Quote, "But it wasn't reducing the risk. You, as an individual, can diversify your risk. The system as a whole, though, cannot reduce the risk. And that's where the confusion lies," unquote. End of section 9.